Hello everybody, Kyle Custer, Senior Analyst here with Jamie Sumner, our Chief Analyst. And as we promised last week, we are going to talk about choosing competitors and how we look at a competitor analysis here at Seafried and Brew with our Performance Risk Essentials with the Competitor Watch. So a lot of what we talked about last week was looking at the bank, comparing it very quickly to a peer group and a benchmark. This week we're going to focus a little more on the competitors, but we're also going to get into the risk, which is our big quintessential thing here at Seafried and Brew, is our proprietary measure, and it's very useful.
That's right. When we look at risk, we look at the primary areas of risk within inside the institution, such as earnings risk, credit risk, liquidity risk, and capital risk. And we also add in there then risk outside the institution with the economic risk, both national and the state risk area. But overall, you can see inside of this image, which is inside the performance risk report, the essentials version, the overall risk score. And this bank in here, the same bank we used last week on the snapshot report, at a risk score of a 41.5. So in and of itself, we can see that it's right inside this yellow area here, so indicating a moderate amount of risk. For the most part, this is where community banks tend to fall in this moderate area of risk. And then we have to balance that out with the overall reward score. So the reward score is at a 57.6. So that's a pretty nice reward score, teetering on that green area, which we identify as well-performing institutions in here. But when we look at the risk, we want to also focus on the distribution of that risk, because you can look at it in isolation by yourself or amongst the other institutions inside the benchmark group. So you can see we have this distribution graph here, and it kind of gives you an indication about where these banks are falling. So you can see here 508 institutions amongst the total number, about 2,500 banks, fall between the 40 and 45th risk index. And so that's right within inside that median level. The median risk, total risk for institutions across the United States in our community benchmark group totals 43.42. So just above where this institution falls in at that 41.16. So this institution can be said to have slightly less risk than the average institution across the United States.
Sure. So we wanted to really introduce you to our risk index because we're going to get into how the competitors are performing as well. And again, this is looking across the nation, but our competitor watch is a really useful tool where you're going to compare. We have 3 competitors that we've chosen, and we're going to look at how their risk and reward is balanced. But first, we're going to, of course, now this sheet, I know it's difficult to see, we're going to zoom in. We went over something very similar last week. These are our financial comparison pages. There's 2 of them. And in this case, we have the sample bank again, same one we had last week, same numbers. Now we have competitor 1, 2, and 3. Now 1, there's many ways to choose a competitor. Now naturally, there's the quick and dirty way is just by asset size. You can look at your neighboring community bank, plop them in there. So we threw this slightly larger bank in there as a local bank. Competitor 2, we wanted to show you how a low performer compares through our ratio analysis and through our risk reward analysis. Okay. And then competitor 3 we found had some similarities with the bank that we used as a sample. So we're going to see how, even though there's some similarities in the structures of the bank, they definitely can still have a different risk and reward profile. And there's a difference that really shows through in this example. So here we have the example. We're zooming in on overall performance. You've got your ROA and ROEs. And again, we talked about competitor 2 here. There's all these negative ratios. So this bank is going to be flashing red, and we'll see that in a second. Competitor 3 is performing a little lower in terms of reward compared to our sample bank, and then competitor 1 as well is a little lower. We're going to also look at our drivers of performance here, always a good place to start. Net interest margin, our bank that we're looking at has a very high net interest margin at a 4.09. The competitor 3, we saw that was the similarity there. They're around a 4.38. The other two competitors, the bank that's struggling is a 3.43, and competitor 1 is around a 3.77. Kind of more of like an average net interest margin number here. And then what we really found with respect to the net interest margins, Jamie pointed it out, and maybe I can get rid of this. Yeah, get rid of this here. Jamie pointed out this. You want to talk about the yield on loans? It's going to be hard to see. So
yeah, so overall when we're looking at net interest margin, there's obviously the components that go into that, yielding earning assets and cost of funds. And then within the yielding earning assets, it's the cost, it's the overall loan yield and the investment yield. So this institution, they have a pretty high, that 4.9 net interest margin. Their loan yield is at a 6.68. So that's a really high loan yield for this institution. And if we were to look at another page to see the distribution of the loans, you would see that they had upwards of 66%, actually 66.97% of their loans inside the residential real estate. So that's a big chunk inside residential real estate, earning what I would consider a very high yield in that area. So you're looking at maybe some higher risk lending with inside this institution.
And we surmise as well that the competitor 3 had a similarity, and we saw that in the non-current loans, which was on the previous sheet. They're relatively high, and that will show in the credit risk portion. Here's another example on looking at the other page of the financial comparisons. We're big on cash type deposits. I think every bank should be. And our sample bank actually only has 43% of their total deposits. So they're paying a little more. It's not as sticky money. In fact, most of the competitors we have here are relatively low in that cash type deposits. We like to see in the 70s and even higher. So another key area that we like to point out, but we want to get to the risk numbers as well here. And let's zoom into the components of the risk.
So as we said before, we look at the risk in its very high level, looking at the credit risk, earnings risk, liquidity risk, and then overall capital risk in here. And you can see the difference between these institutions. We mentioned before how the bank that we're looking at here, which would fall into this category, they have a moderate to high level of risk at that 61.1% in that credit score. And that's kind of would be expected with that high level of yielding earning assets, particularly with inside the loan portfolio. And a look on the competitor 3 over there, Kyle just marked, it's 65.35. So they also have a very high level of risk, or moderate to high level of risk inside there. And then these two institutions in between kind of fall between there, 48.6 for competitor 1 and 35.87 for competitor 2. So dropping down from your overall credit risk, which is probably where most banks have issues or can run into issues very quickly, we look at earnings at risk. And earnings at risk, basically our model defines it as a sensitivity of net interest margin over a period of 9 quarters. So they're at a moderate, our sample bank here is at a moderate risk area at that 57.44. And then the rest of the institutions you can see are all low. And this is almost primarily where we're seeing institutions these days, in this low area in here. So this is kind of an anomaly within the numbers that we look at, this bank being at that 57.44. Liquidity risk, which is becoming more and more important as we move along here in these low interest rate environments. Our sample bank at low, and then we have a moderate to high in competitor 1, a low to moderate in competitor 2, and then another low down there in competitor 3. And then capital risk, of course, is important, especially with the capital buffers coming in place this year and then slowly being phased in throughout the next couple of years here. You can see where our capital ratios are, and these kind of our weightings here kind of line up with where the buffers lie. So we have the low here for our bank, and then we have moderate to high for institution competitor 1, moderate to high institution competitor 2, and then another low at the end there, competitor 3. So you can see these banks that are taking high level credit risk have opted to have an increased level of capital within inside of their portfolio. with inside of their bank, and that's important. That's what we want to see.
Yeah, and I really like here too is it tells you how many banks are higher risk. So in the case of the two banks we're showing, we're talking about the credit risk. Both of them have about 200 banks out of that 2,500 group that are higher risk. So it gives you that idea that, hey, you know, we're really at that top tier. You know, maybe we should bring that down a bit. So the nice little tool here.
Yeah. So we looked at where we were individually with inside of those different risks. But also we have to remember we want to collectively see how the risk interplay with each other and do they balance each other out. So when we look at the overall risk scores, you can see this institution overall we're giving it a low to moderate level of risk. And that being because they have that hefty amount of capital on their balance sheet, giving them that low level of risk in the capital area, kind of a low level with inside of the liquidity, and then we have the higher levels in the capital and earnings at risk. So they're kind of balancing out. So you see they're in the low to moderate, the competitor 1 in the moderate, low to moderate for competitor 2, and then low overall for competitor 3. And then we look at the reward scores, kind of intermixing the reward scores here, moderate performance and moderate performance, underperforming because they're losing money at this institution, and then low performance down in competitor 3. So when we look at them, risk and reward, got to make sure we try to balance them out. Overall, this institution, the sample bank, is at that great level, that green level. They have been able to adequately balance that risk and reward to get a very high composite ranking of 64.9. And then we have the fairly balanced competitor 1 at that 33.6 percentile rank. Competitor 2, very low, underperforming, unbalanced, we would say, at that 2.8 competitor, or the ranking. And then competitor 3, fairly balanced at that 36.5 on the composite ranking basis. So overall, this institution, the sample bank, while they have a high level of credit risk, everything taken into consideration, it's a very good institution operating fairly optimally when you look at the risk and reward for this quarter.
And that's really what we were talking about for the most part here is this quarter and how they're doing this quarter. And what we're going to get into next week is more of a trending analysis and share how we here at S&B do trending analysis. Now this is part of the PRE that we just went over, and this gives you a risk and reward trending graph. And then you can see here, well, Jamie actually pointed out, of course, the high credit risk, but this bank has been maintaining that. So it must be something that they're structurally prepared for. It's part of their business plan, issuing those type of loans. But something happened here. Something with the earnings at risk shot up. And that's where you see the composite score come down here. And of course, we have the fourth quarter. They must have posted very low earnings, if not a loss. So, well, next week we're going to look into it and figure out what happened.
All right.
Thank you very much.
Thank you. Have a great week.